I get this question all the time. What's the difference between a stock and an asset purchase?
Yep, it's a really good question. So I think we could start with the stock purchase. So these are kind of what I was talking about in the prior section, what the motives are by each of the buyer and selling parties. The seller is always going to want to sell stock. In very rare circumstances are they going to want to sell assets. It does happen. But generally speaking, if you sell stock, you're going to get capital gain treatment, which is subject to favorable tax rates on your sale of the stock. A buyer does not want to buy stock, and I'll explain that in a second. An asset purchase is exactly what it sounds like. So if you go and you sell your assets, you're going to calculate your gain or loss. As a seller, if as you would if you would have sold those assets individually. So generally, what we see is that an asset sale is going to result in more tax because of items like depreciation, recapture. Things like that are subject to ordinary income tax rates. If another example would be if you have cash basis accounts receivable that are sold, that's going to result in ordinary income. And then obviously inventory, if you sell inventory, that's going to be ordinary income. So obviously there will be a portion of the gain that's subject to capital gains tax rates, but there will be a portion or could be a portion that's subject to ordinary rates, which are higher currently than capital gains rates. The other aspect of this is in an asset sale or an asset purchase for the buyer, they're going to get a step up based on their purchase price. So let's say that you pay $1 million for a business and there's no actual assets, you're just buying an intangible. Well, if you were to buy that company and purchase the stock, you would get no tax benefits from that. All of the benefit would be held within that stock itself, meaning that's your basis in the stock. So let's say 5 years down the road, you go and sell that stock. That's when you would recoup your $1 million investment and you'd be able to offset your tax, assuming you have a gain on that exit. With an asset purchase, that $1 million purchase price in our situation where you're only acquiring an intangible would be amortizable over 15 years. So you would get a tax benefit every year. And that's generally how it works with an asset purchase. So you've got the two main situations here. You have a seller who wants to sell stock to reduce their tax, and you have a buyer that wants to purchase assets so that they get those tax shields for future years. A couple other differences is, we talk about successor liability, and, I'm not an attorney, but from a tax standpoint, generally when you acquire the stock of an entity, whether it's a C corporation or an S corporation that terminates and becomes a C corporation, you are inheriting the all historic liabilities of that entity. Federal income tax, state income tax, sales and use taxes, everything. When you purchase assets, you can generally shield yourself from the income tax areas. And usually what we see is the successor liability in an asset sale can transfer, but it's usually limited to non-income tax areas such as sales and use taxes, payroll taxes, things of that, gross receipts taxes, things of that nature. And then obviously, that can impact the deal in and of itself, which we'll get into a little bit later. But, when you're purchasing stock, the level of, due diligence a buyer has to perform is much greater than when they're only purchasing assets.